Welcome to StockMarketPunding.com, home to the professional trader, hedge fund managers, new beginners, everyone alike. And what we're doing today with SMF Pro trading students and within our trading network that are listening on the other PA system is that we're happy to announce to you a monthly chart of the S&P 500 and a weekly chart of the S&P 500. And what we're going to show you is that where we're at within the actual trend cycle. And basically it's 10:34 a.m. in the morning, and Rick Goley will let me know at a 9-minute so I can stop the tape so it's not longer than 10 minutes. So basically on a monthly level, which is this right here, what I want to point out once again is that the Dow hit a monthly sell signal back over here in the financial crisis. And it's almost, they are trying to walk this thing to get back to a monthly buy signal. And a monthly buy signal would be bullish because that's what it would be. However, from a monthly level right now, we are 90.01 on a percent DS level reading, which means that as the market climbs higher, divergently it's going to have a hard time to have a sustainable closing price, sustainability looking forward above that 1200 because we're too overbought here. Now, let me show you on the weekly cycle up here or down here is that, let's take a look at this weekly chart. This is the same cycle period. This green line is called the 200-week moving average. And basically, when you look at this, we were 92% on Friday. This is extremely overbought. And that 200-week is ultimately going to be resistance. Now, for me to say if this market's going higher, I would have to have a closing price and a support level above the 200-week. And we had a lot of selling on Friday. And we are in a 3-week earnings season, and we don't put it past them. It's just that we are getting totally overbought on both charts. And because we are. What I would like people to know here is that 92.21% overbought. Yes, we're in a quarterly earnings season. Yes, so far we've had good reports. And all of the news might be good, and some of the economic indicators in the cycle are good too. But what you need to be aware of, and what we're looking at, is the other side of this overbought level on the weekly. Here's the monthly. It too is at 90. And that means that the more overbought on the weekly and the monthly that you get, the harder it is for that big breakout to occur, and where resistance has more of a resistance. Now, just to give you an example, if the indicator here on the percent DS was at a low level of 25 or 30 on a monthly, and or on a weekly down here where it's 92 but now 90, if those were much lower levels on the percent DS as far as being oversold or overbought, is it would be easier to go through those resistance channels, because it would. And what the SMF Pro trading students are going to learn is how to develop a position management trade based on risk management parameters, trading the S&P index using a volatility call up here above the markets where this level is, meaning that now that we've had the drawdown on Friday because of the Goldman news, we would draw a horizontal trend line right across here. That's the top of the down bar. That is a 1291 on the S&P. And what that really means is that we would look at buying a 1260 call up and out of the money called a volatility trade. Then we are going to look at, because we're overbought, is buying below the market for the test and buying below the market put options. However, instead of being one-sided to the overbought condition in the markets, is the reason why we're going to invest money on that volatility is because if they gap that thing up and then they gap our puts down, we're going to get value on the other side and that's why it's called a volatility trade. And it's about learning how to trade indexes, long and short. Volatility is volatility. If we continue the down move from the Friday sell-off right here, the beginning of that downtrend, options expiration Friday, is that you can see how down the indexes were. However, for every down move, there's a volatility upward move. And when it comes to the fine part of risk management on a position trade, is that you have to put the collar of that volatility trade on up and out of the market. And in series part 2, tape number 2, is I'll go more in depth as to what those calls and those puts would look like. And the downside is that, yes, volatility, a gap up, some kind of headline, you're covered for a small price that offsets that volatility gap. Bulls like to create volatility gaps. And gapping up, gapping down, you're not looking at making money on this side of the trade. And any gap up, you would sell. And that would neutralize your put position and dollar price value. And it's very important that however many volatility gaps there may or may not be, is that you would actually execute that and leave that put option alone. Because you're covering the cost of the put option as you're trading the potential volatility gap. And in our SMF Pro Trading School, we are happy to announce to you, whether it's trading indexes, bear and bull funds, rather any different type of instruments in risk management position trades, always using a volatility trade. Because bear and bull markets, headlines come out, people create scenarios, just like the Goldman news that came out and sent the markets into a tailspin. That's a volatility downside move. Bulls didn't have that. Bulls are fully invested in the market right now.